Okay, so how do companies pay dividends? This is a question that a lot of people ask, and I have an answer for you. So of course, this is more of a beginner style video, so if you already know how companies pay dividends, this is not going to get into any of the technical terms or anything like that. So basically, how does a company pay dividends? A company pays dividends out of their earned income, out of their cash flow. And basically, companies that pay dividends usually have a guaranteed cash flow of revenue coming in. So a very good example would be a bank. Canadian banks pay dividends. They're usually between somewhere in the range of 3 and 5% per year. And you may be saying, wow, so if I risk $100, I'm only going to get $5 in return. If I risk $1,000, I'm only going to get $50 in return every year. But you're investing in these businesses long term. Let me explain. So as we all know, there is a thing called inflation, but also there is, of course, future revenues that do tend to go up. Businesses don't just stay stagnant, they increase their revenue every year. So basically what happens is, let's say they have a good increase, whether it's from inflation or whether it's from the ability to make more money every year, whatever that is, they will pay you more. So for example, Canadian banks will generally increase their dividend in that 7 to 20% range every single year. So if you were making 1% dividend one year, the next year you could be making a 1.2% dividend. Now that's maybe not a massive change, or if you go from a 3 to now a 3.6% dividend, that's not a huge change. But if you're looking long term, if you're saying, well, I'm 30 years old, by 50 years old I want to have an income from not having to work, then dividend stocks can actually do that for you, because in that 20-year period, they're going to be incrementally increasing their dividend. And from your initial investment in 10, 15, 20 years, depending on businesses and how much they increase it by, you could literally get your entire initial or original investment paid back to you every single year. So this is how people can retire early. So if you can save up a lot of your money and you put it aside and you invest in dividend stocks, the price of the stock hopefully goes up. They increase their dividend, hopefully. Apple has been doing that, and obviously the Canadian banks that I follow a ton tend to do that a lot. Canadian banks actually have never decreased their dividend in well over 100 years if you look at the top 6 banks. So once a company starts paying a dividend, sometimes an investor will say, I'm no longer interested in that business because now they're paying a dividend, and instead of reinvesting that money in their business, they're paying it out to their investors. And while for higher growth investors, you may not be looking for a dividend stock, for people who want to supplement their income, like myself, I run my own business, I run 5 different YouTube channels, I want businesses to pay me money so that I don't have to work a regular job. So that's why dividend payments are so important for those who, in my opinion, work for themselves. So basically, long story short, is a company, let's say they make $100 million, let's say they're thinking, okay, well, we can put $50 million away, let's pay out $50 million to our investors, and that could be in the range of a couple of dollars per investor or even more, depending on how many shares that are out on the market. Anyways, I hope that this video has helped explain how companies pay dividends. It's basically just out of their revenue, out of their income. And they say, well, we've got a surplus of revenue, we got a surplus of income, let's just pay it out to the investors, make the investors happy, and maybe get a few more investors who want to have dividends paid to them. I hope that you've enjoyed. Hit that like button, subscribe, and I'll see you guys again next time.